Okay, so in part one, we basically defined what GDP was, what was included in GDP, what was excluded from GDP. In part two, we basically defined the formulas that we use to calculate GDP. We learned that we predominantly use the expenditures approach, which is consumption plus investment plus government expenditures plus the value of the country's net exports. And now what we're going to do in part three is define the difference between what we call nominal GDP and real GDP. Now, if we're talking about nominal values, we're basically just looking at the current prices of goods and services. But what we're concerned with is what we call the real value. So whenever we're discussing GDP, we want to make sure that we're looking at it in real terms. So you'll notice that my definition of real GDP right here basically says it's the value of goods and services using a constant set of prices. What we're basically saying is that we've adjusted for inflation. In other words, real GDP takes into account the fact that price levels change. And so if we're just looking at nominal values, it could be very misleading as to whether the economy is growing or not, because you haven't taken inflation or deflation for that matter into consideration. So again, we always want to make sure that when we are calculating GDP, we are calculating it in real terms. It will make a lot of sense if we look at an example, in other words, looking at something in real terms versus adjusting for inflation. So let's say, for example, that this year a DVD is going to cost you $10. So obviously, if we produce 10 DVDs, it will have a market value of $100. In other words, you would just take the price of the good, which is $10, multiply it by the quantity, so that's all we're doing, price times quantity, and we're getting $100. So that would be the nominal value, right? Now, let's say next year there's inflation. Let's say there's a 50% inflation rate, which means that same DVD is going to cost you $15. And at the same time, we still produce the same number of DVDs. We still only produce 10 DVDs. So for the following year, again, looking at the nominal value of output, you would do price times quantity. So now the price is $15 multiplied by the quantity. We have a nominal value of $150. So compare those numbers. In other words, one year we produce $100 worth of output. The next year we produce $150 worth of output. It makes it look like we produced 50% more than we did in the previous year, because we haven't adjusted for inflation. In other words, did we actually produce 50% more? Absolutely not. We still produced the same number of DVDs. We only produced 10 DVDs. The only thing that changed was the price level. There was inflation and the price level increased. So this should really hammer home the concept of why we always want to look at things in real terms. We want to adjust for inflation. Otherwise, it makes it look like we're increasing our output when we really haven't. So we have to know, how do we adjust for inflation so that we're always looking at things in their real values. All right, so whenever we are adjusting for inflation and looking at things in real values, you have to have what's called a base year. So notice in this table right here, I've identified my base year as the year 2000. And what the base year is that gives you the price level that all other years are going to be measured against now. So that way we're keeping constant prices. So if 2000 is the base year, then that's the price level we're going to use for output in every year before that to every year after that. So you can choose whatever base year you want. So here I have a hypothetical example where we have good X, and I can see the amount of output that was produced of good X in both 2000 and in 2005. In other words, in 2000, the quantity of output that I produced of good X was 200 units. And we can also see that the price level was $4. In other words, if I would have purchased this good in 2000, I would have paid $4 per unit. And then I can see how the quantity of output and price levels changed 5 years later. In 2005, this same firm produced 220 units of good X, and the price level had increased. So there had been inflation. Now the price of that good is $6. So from this information, I can calculate both the nominal values of GDP in both 2000 and 2005, and I can calculate the real values of GDP. In other words, where we take inflation into account, since I'm establishing the year 2000 as my base year. Now, nominal values are easy to calculate because nominal is just price times quantity. So if I want to know what the nominal value of GDP in 2000 is, I would just multiply 200 times 4, and I would come up with $800. So I can see that right here. In other words, here's the nominal value of GDP in the year 2000. And then I can do the same thing for the nominal GDP in 2005. Just take price times quantity. So in 2005, I produced 220 units of output. The price level was $6. So the nominal value of GDP was $1,320, which again we see right here. So again, when we're looking at both of these, it looks like when you don't adjust for inflation, it looks like we really increased our output. In other words, we went from producing $800 worth of output to $1,320 worth in output. But again, that's misleading because it's not in real terms. We have to adjust for inflation. So now we're going to calculate real GDP for 2000 and in 2005. And what you do is you use the price level of the base year. So we can see that the price level in the base year equals $4. And of course, normally we're looking at average prices for all goods and services. We'll look at that in just a second. We use what's called the price index. But right now, we're just keeping it very simplified. We're pretending that we only produce one type of good. Therefore, the price level would be whatever the price of that good is. So the price level in the base year is $4. So that means every year that we want to calculate GDP, we multiply it by that base year. So obviously in the year 2000, because it is the base year, the nominal value will be equivalent to the real value. So again, we would take 200 units of output and multiply it by the base year price, which is 4, and we still come up with $800. So that's always going to be the case. In other words, your nominal value will be your real value in the base year. But notice what happens to the real GDP for 2005 once we use the price level for our base year. So we take the quantity of output that we produced in 2005, which was 220 units, but we multiply it by the price level in the base year, which is $4, so that we can just again measure the true increase in output. So 220 times 4 is 880. So now we can look at it in real terms. In other words, when we've adjusted for inflation, we see the amount of output that was produced in 2000 was $800, and the amount of output that was produced in 2005 was $880. So that now we're looking at it in real terms. We can still see that there was an increase in output, but not nearly as much as we would have assumed if we had not adjusted for inflation. So once you've adjusted for inflation and you're looking at GDP in real terms, that allows you to calculate the growth rate between years. In other words, how much did the economy grow? How much did our GDP or economic output increase or decrease? And so in order to calculate the growth rate, you're just going to use a formula to calculate the percent change. So you've probably learned this previously in a math class, easily calculating percent changes. So in this case, because the time period that we're normally looking at is a year, you would do the value of GDP in year 2 minus the value of GDP in year 1, divide that by the value of GDP in year 1, and then of course multiply it by 100 in order to get that true percent change. So if we look at the data from the problem that we just did, we said that the real GDP in the year 2000 was 800 and the real GDP in 2005 was 880. So if we wanted to know the growth rate of the economy between between the years 2000 and 2005, we would just plug those numbers into that formula. So 880 divided by 800 divided by 800, and then take that value and multiply it by 100, we could see that the growth rate between those years was 10%. So again, we could say that between the years 2000 and 2005, the economy grew by 10%. We increased our output by 10%. Now, I did state that in our previous example, I was completely oversimplifying the economy and saying that we're only producing one good. So that's why I was just using the price of good X, which was $4. In reality, we produce lots and lots of different goods. So we have to look at average price levels of everything being produced in the economy. So we use what's called a price index. And the value of the price index in any year indicates how prices have changed relative to the base year. So the base year, again, we've already established, is the year that all other years are measured against. So in our previous example, we said the base year was the year 2000. So that would mean that the price index value would be 100. In other words, the value of the price index in the base year is always going to be 100, meaning that the prices in the base year are 100% of the prices of that year. So we're just saying that they're equivalent to what the prices are. And then, of course, you use the growth rate to identify how the price index changes from year to year in relation to the base year. So again, in our previous example, we already stated that 2000 was our base year, which means our price index would have a value of 100. So in other words, prices are 100% of what they are in the year 2000. And then we want to know, what is the value of our price index in 2005? You just add the growth rate to that. In other words, we already established that the growth rate was 10%. So 100 plus 10 would be 110. So the value of the price index in 2005 would be 110. And so what that tells you is that prices are 110% of the base year, or basically 10% higher than what they were in the base year. Okay, so before we move on, let's just do one more quick example so that we understand how to calculate nominal GDP, real GDP, how to establish the growth rate, and then how to use that growth rate to adjust the price index. So let's say that we have 2 years, 2014 and 2015, and let's say that we have 2 different price levels going on for good X that we are producing. So we're still talking about hypothetical good X. Let's say in 2014 the price of good X again was $4, and let's say in 2015 the price of good X was $6. In 2014, let's say we produced 100 units of good X, and in 2015 we produced 120 units of good X. So from that information right there, it makes it very easy for us to calculate the nominal value of GDP, because nominal value is just price times quantity in their year value. So again, for 2014, we would simply, do 4 times 100, price times quantity, you come up with the nominal value of 400. So that would be our nominal value of GDP. And then we do the same thing for 2015. You just do the price times quantity in their nominal terms. So the price level was $6 per unit. We produced 120 units. So the nominal value of GDP would be 720. So that would be the nominal value of our GDP that we could fill in our table. But again, if we want to look at things in real terms, then we need to adjust for inflation. So we have to establish what our base year is going to be. So let's say, for example, our base year was 2014, which means we're going to measure prices against 2014. So again, to calculate real GDP for 2014, we're simply going to do price times quantity, and we will come up with the same exact term, because the price level in the base year is what we're using. So the price level is $4. We produced 100 units of output, so the real value of GDP would be 400. But of course, to do the real GDP for 2015, we use the price level of the base year, which was $4, and multiply it by the quantity of output that we produced in 2015, which was 120. So in other words, the real GDP for 2015 would be equivalent to 480. So again, very, very different than the number that we came up for nominal GDP when we're adjusting for inflation. Next, we want to know, well, how do we know what the value of our price indexes are for these years? Well, again, we've already established that the base year is always going to have a value of 100. So in other words, the value of the price index for 2014, if we establish 2014 as our base year, would be 100 then. In other words, prices are 100% of what they were in 2014. But to know what the price index for 2015 is, we need to establish what the growth rate is. So remember how we do the growth rate. In other words, to calculate the growth rate, we would do year two minus year one divided by year one, and then we multiply that by 100, and that will give us the percent change, in terms of the price level. So again, the year two GDP we established was 480 minus the GDP for year one, which according to our table was 400. And then we divide that by the value of year one, which was 400. And then of course we'll end up multiplying that by 100. And so the number that we come up with, 480 minus 400 divided by 400, we end up coming up with 0.2 or 20%, because we'll multiply that by 100, and then we come up with 20 and then express it in a percentage term. So the growth rate was 20%. The economy grew by 20% between the years 2014 and 2015. So again, this was our growth rate. And so we add that to 100, so therefore now we know the price index for the year 2015 would be 120, because you would have just taken the value of the price index in the base year, which was 100, and added the growth rate. And that's how we came up with 120, which again ultimately becomes the value of our price index for 2015. Now there's different types of price indexes that are used. I'm just going to briefly go over the three common ones, and then I'll tell you which one that we use the most, which is the second one. But the three common price indexes that you'll often hear about would be what we call the GDP Price Index, the Consumer Price Index, or what we call the Producer Price Index. So the GDP Price Index, or often what we refer to as the GDPPI, is just a very broad measure of the prices of goods and services included in GDP, because it reflects the price changes of all categories of goods and services. So in other words, the price index that is used to estimate constant dollar real GDP changes is the GDP Price Index. But if we want to analyze more specific categories of goods and services, we're not going to want to use the GDP Price Index. The most common price index that you've probably heard of is what we call the CPI, or the Consumer Price Index, and it includes a much smaller, what we call market basket of goods. It only tracks the price changes of the average goods and services that are purchased by the typical household in the United States. So it is calculated by the Department of Labor. It's done every 2 years, and the data is taken from 87 U.S. cities. And so again, they're basically looking at how the prices have changed of goods that the average household purchases. So the two biggest items in the CPI that they track would be the cost of housing and transportation. But those, of course, are not the only items that the average household purchases. They also look at how has, the cost of education changed, how much has the cost of food and beverages changed, how much has the cost of people's average recreational activities changed, medical care. In other words, again, they're not tracking the changes in prices of everything. They're only tracking the prices of the price changes of the average goods and services that the average household actually purchases. So again, consumer price index is going to be useful to let an individual know how the average prices of goods that households actually buy have changed. Now, of course, this doesn't mean that it's going to be a good measure of your cost of living, because you may not buy, or spend the same amount that the average household is spending on these goods. And then the last price index I want you to know is what we call the Producer Price Index, or the PPI. And this measures the average prices received by the producers. We sometimes call it the Wholesale Price Index because it's tracking the price of resources. So oftentimes we use the Producer Price Index as an indicator of what we expect to happen to prices that the average consumer buys, because theoretically, if producers are paying more for their resources, so if the Producer Price Index is going up in value, then eventually that's going to cause the Consumer Price Index to go up in value, because it's going to cause the price of goods and services to rise, since firms are having to pay more for their resources. The last thing that I want to touch on in terms of Chapter 5 would be how we often express gross domestic product. Oftentimes we look at it on a per capita basis, and that's because if we don't, it could be deceiving if there's huge population changes. So for example, let's say if real GDP over a 5-year period rose by 100%, you might conclude that the real income of a typical person in that economy actually increased, because again, if real GDP or output is increasing by 100%, that means income has increased by 100%. But what if during that same period population increased by 2,000? Then we can see that that would not mean that you can draw that conclusion that the average household income theoretically increased. So again, oftentimes when we're looking at GDP, we see it expressed on a per capita basis. Okay, so let's review a little bit what we've learned in this chapter. Suppose I gave you a table of information that looked like so. So I have 3 different years, 2007, 2008, 2009, and I say that 2008 is the base year. I give you the nominal values of GDP, plus I give you the values of the price index, and I want you to tell me what the value of real GDP is for each year. So again, in our previous example, I gave you the price level, and then I had you calculate real GDP and price index from the changes in the price level. But in this example, I'm just giving you the nominal GDP and the price index and telling you to establish what the value of the real GDP is. So basically, all you'd have to do to calculate the real GDP is calculate the price index by the value of the nominal GDP of the base year to establish what the value of real GDP is from year to year. So for number 1, I said, what is the value of real GDP in 2007? So you would take the value of the price index in 2007, which is 97.9, which is basically saying that price levels were 97.9% of what they were in the base year, and then multiply it by the value of output in the base year, the nominal GDP, which is 8,500. So 97.9 times 8,500, we would come up with a real GDP value of $8,321.50. So that would be the value of the real GDP in 2007. And then I ask you for what is the value of GDP in 2008. Well, again, you take the value, the price index, which is 100, multiply it by the base year nominal GDP, which is 8,500. So in this case, 100% of 8,500 is going to be 8,500. So in other words, the nominal GDP will be equivalent to real GDP in the base year. And then, of course, for the third year, 2009, we take the value of the price index, which is 102%, and we multiply that 102% by the value of output in the base year, which was 8,500. So in other words, 8,500 times 102% would be $8,670. So in other words, we can see what the real value of GDP was. And of course, notice that I'm multiplying it in percentage terms. So like this 102%, since I'm looking at it in percent terms, that would be actually 1.02 times 8,500. And then the same thing up here. The value of the price index was 97.9%. So when you multiply that by 8,500, remember that you're expressing it as a decimal point. So 0.979 times 8,500. And then that's how we're coming up with these values. Suppose I gave you this table of information right here. So this is going back to one of the previous lectures for chapter 5. So it's giving you the added value for each stage of production. And I ask you, what is the value added from the soda machine retail stage equal to? So again, we can see that wholesale Pepsi was sold for 40 cents, and then it ultimately sold in the Pepsi soda machine by 60 cents. So all you would do is take 60 cents minus the 40 cents, so we can see that the added value by the soda machine retail stage was 20 cents. In other words, you just take the difference between what they paid for it from wholesale Pepsi and what they ultimately sold the soda for. If I asked you how much did this soda contribute to GDP, it would be the 60 cents. In other words, what the final value was that it sold for. Suppose I asked you which of the following would be included in figuring GDP as income. So again, which one of these would be an income category? Well, of course, we see consumption, investment, government spending, and imports. Those would all be included in calculating GDP as expenditures. In other words, the amount of money being spent. The only category on here that is included in an income category would be profits. Remember that we calculate GDP as income looking at the total amount of income generated from resources, the total amount of profits that are being generated by the firms, and then of course we add in the value of the capital consumption allowance and the indirect business taxes. And then lastly, let's say that I give you a problem like this, and I say that for a hypothetical economy, GDP was $10,000 in a given year. Consumption equaled 9,800, gross investment equaled 125, exports were 255, and imports were 500. What was the value of government spending? So again, we know the formula we're using is C plus I plus G plus X. And then that will give us our GDP. So we're basically going to be solving for X here. If you think about it, we just start to fill in these numbers for a formula. So it says the consumption was 9,800. So there's my C value. It says gross investment was 125, so there's my I value. We're trying to figure out what the government expenditures were, so that's the X that we're solving for. And then the net exports, and we know is exports minus imports, so the value of the exports was 255. We have to subtract out the imports, which was 500, and all of this is going to equal 10,000 because that is the total value of our GDP. So if we do the math out here on the left-hand side of our formula, and we do the 9,800 plus the 125 of gross investment, but then we have to subtract out the negative value of our net exports, we end up coming up with 9,680. Plus X equals 10,000. And so again, all we would have to do now to solve for X is subtract 9,680 from this side of the equation, so that cancels that out, and then do the same thing over here. Subtract out the 9,680 from the equation to see what we're left with. And so when we do 10,000 minus 9,680, we come up with the value of $320. So therefore x equals 320, which means the government expenditures had to equal 320. So that would have been our correct answer right here.